Good afternoon, everyone. I am Serafina D'Souza, Project Coordinator for Moneylife Foundation. I would like to start by welcoming each one of you to this session on Investing Smartly by Mr. Debashis Basu. I now have the privilege to introduce our speaker for today's session, who is also the founder trustee of Moneylife Foundation and the editor and publisher of Moneylife magazine. Mr. Debashis Basu is a chartered accountant by qualification with over 29 years of experience as a journalist and the author of several business books like The Scam, Pathbreakers and the Plain Truth series. I now invite Mr. Basu to please begin the session. Thank you.
Thank you, Sarah. Welcome from our side once again to Moneylife Foundation's event. We've done this particular program several times in the past, but I see a lot of new faces, so I'm very, very happy to share this. It also includes a lot of new learnings for us when we are constantly learning from what's happening outside in the marketplace, how savers are dealing with financial products. Very often they feel let down, they feel cheated. We write some of these stories, some of these cases in the website, in the magazine, and some of those learnings that we, as I said, learning constantly about regulation, about savers' problems, are also reflected in this new presentation. We'll have a question-answer session in the end, but if you do want to stop me in the middle of any of the slides, and if you have something that you think that you might forget later or something that relates to that specific slide and you want to ask, please by all means raise your hand and ask a question. One other thing I must request you, there are a few people who are sitting outside, and for their benefit, please speak whenever you want to speak into a mic. One of my colleagues will sort of pass on the mic to you so that people outside are able to hear the question. They'll be able to hear the answer in any case when I speak, but they would like to hear your question as well. Our premise at Moneylife is very, very simple, which is that there are a large number of products which are constantly being created by financial services companies. Now, there could be an insurance company or a mutual fund company or banks, or many of these products are not something that is suitable for us. So unlike let's say a healthcare company, they create let's say a new drug, and they have tested it, they have figured out that this is required for this kind of person, for this kind of ailment, and it goes through 8 to 10 years of testing, and then eventually it's prescribed by somebody who is a specialist, who knows his subject, who's learned the entire area of medicine for over years, and then he prescribes. So usually there is a certain amount of method that goes behind all of that. Unfortunately, in financial field, although it's as big as, let's say, healthcare or any other area, this sort of method or process is not usually applied, and with the result that there are a lot of products that are unsuited to us, which we buy without realizing, and then there's a lot of heartburn and anger and so on and so forth, and we try to look for a redress. We have looked at this whole thing, and we think that if you understand this into 4 segments, in 4 different ways, if you try to break it up into 4 different angles, this particular area of financial marketplace, a lot of things will fall in place, and you'd probably not make the mistakes that you heard others make or you would have made yourself. First is, of course, I call the marketplace, the world outside, and that I'll explain what it means. The second is, once I understand what the marketplace is, I start planning for myself, planning smartly, exactly what I need and what my goals and targets are, and once I decide on that, for my particular case, it could well be that 60, 70, 80% of the products that are out there are not relevant. It's as high as that, right? It's exactly like medicine. You have a specific ailment, that particular medicine is what you need. You got nothing to do with 20,000 other drugs that are there in the marketplace. To arrive at that, obviously you have to know what the products are. What is a health insurance plan? What is a life insurance plan? Within that, what is a term plan, for instance? What is endowment? What is LIC selling when they are telling us to buy a guaranteed NAV insurance plan, let's say? Or what is a money back? These are the products. They come under 4 or 5 areas, like insurance, like stocks, like mutual funds, and so on and so forth. Most of these are regulated. In India does not allow too many unregulated products to be sold to us. There are regulators. There is an insurance regulatory authority. There is SEBI. There is RBI, and so on. Something that's completely unregulated and sold to you, also happens. One of the biggest areas of that is, for instance, chain money scheme. Nobody is regulating. At the Rose Valley in Calcutta or Speak Asia, all over the world, all over the country, nobody is regulating. They're coming and asking for money from you. Some of the others are half regulated, somewhere there. They're not exactly regulated, but you get a sense that they are regulated. They're equally harmful, if you don't understand the risks of it. For instance, corporate deposits. Now, if I'm a large company, I can come and say, I'm giving you 12% interest, give me money. Now, who regulates a product like this? Nobody. They may have got a rating from a rating agency. It's a company, so it's probably filing with Registrar of Companies. There's a Minister of Corporate Affairs. But all that's irrelevant if they don't pay you back your money. There's nowhere you can go and complain. You cannot tell anybody that I have given 5,000 rupees to Kirloskar Finance. I've given a very good example because Kirloskar is a fantastic name, especially in Maharashtra, and Kirloskar Finance took a lot of money from people in Maharashtra and Karnataka, in adjoining areas, and it did not return the money. It lost it. So these things happen, and it's not regulated at all. So the products have to be something that you require, and they have to be regulated. There have to be a place where you can go and complain. And finally, in some of these products are market linked, as in they go up and down. A fixed deposit doesn't go up and down. You put your money in the bank, you're exactly going to get back what they have promised you. But if you buy gold for investment, sometimes it will be up, sometimes it will be down. So there some amount of some sense of when to buy is critical. I know when I say this, I'm entering a little difficult territory because you've been told by everybody that it's impossible to time the market. And I'm not asking you to buy and sell, but you cannot avoid the fact that if you ever want to buy a product that is market linked, you must find a way. It's common sense. You must find a way to buy when it is low. You should not buy when it is high. So if you do not know the distinction between high and low, in some manner, some rudimentary manners, even some rule of thumb will do, then it's better to avoid that, because behaviorally we are not equipped to buy low. We are equipped to chase and buy high, and you're likely to regret. I'll come to all of that when I explain. The marketplace is pretty complex, but I've simplified this into a simple structure of this. I have nothing in favor or against HDFC Group, so it just doesn't matter that I put HDFC there. Could be SBI or ICICI for all you know. Typically, it works like there is this company which is pretty large. It frequently advertises. It's got a lovely catchline called Saru Thake Jio. And it probably has a celebrity endorsing its product. Could be Amitabh Bachchan in case of ICICI Life Insurance. These products are usually sold through banks. So there's equally large entity, very formidable, very big. They probably make 10,000 crores of profits every year and employ a lot of smart people. Maybe some of your cousins or nephews and nieces are working in these places. You typically walk into a bank and you're a risk-averse customer, which most of us are. And the bank says that, hey, you have so much of money lying in your savings account. Are you properly insured? So let's say you have a kid. Have you provided for your children's education? Or have you thought about the pension that you require when, if you're not working in a government and you need regular income after you retire? This is a product for you. So there is this bank which we trust. There is a word called banker's trust. You trust your bank because he knows you. He's a custodian of your wealth, of your money. He knows exactly. He's the only person apart from you and your accountant who knows exactly how much money you have in your account. He's a third person, literally, and he's a trustable guy. He's part of the bank, for instance, and you listen to him and you buy the product that he recommends. So you've done nothing wrong in this entire chain. This company, both these companies are regulated, one by the IRDA and one by RBI. They are allowed to advertise. Obviously, some rules allow them to advertise. There are people who are endorsing those advertisements. Could be Sachin Tendulkar for Aviva, or could be, as I said, Amitabh Bachchan for ICICI. Nothing in this entire chain prepares you for a shock that this is not the product for you. We keep getting calls and not really calls, but more emails every day, day after day. Ever since we launched the insurance helpline, it's increased quite a bit. But we have narrated literally scores, dozens, and almost like 100 stories where this is exactly the way the script is played out. Change the name of the organization, does not matter. Recently we wrote about a gentleman who was 79 years old, changed the name from HDFC Bank to IndusInd Bank, and changed the name from HDFC Life to Deutsche Mutual Fund. Okay, Deutsche Bank, it's huge, it's the largest bank in Europe. Story is the same. 79-year-old was sold a product with a 10-year lock-in. He needs money for his wife's regular treatment. Is this the right product for him? No. Was it the right way to sell? No. Will he get his money back? No. There is no provision under the law by which he can establish that he has been cheated, that there was misrepresentation. We decided to write about this story, made a lot of noise. We have strong presence in Twitter and Facebook. That's the thing that works these days a lot more than simply writing. And eventually IndusInd Bank probably felt a little ashamed. They went back to his house, gave the money back. It was another small victory for Moneylife, but just one case, and there are hundreds of such cases happening day after day. In some cases, our writing does make no difference. Companies are shameless. They may not return the money back to you. So this is a marketplace. All right. Why are we so unfamiliar about this marketplace? Why is it that we get to know of this only when something happens to us, or when we read something like this has happened to someone else? But usually when something like this happens to a neighbor or this or that, we are not exactly interested. It's a curious thing. He was not smart. He didn't know. It won't happen to me. I mean, that is typically the reaction. But you never know when exactly, under what influence or what pressure, whether it's greed, whether it's persuasion, doesn't matter what, you agree to tell the relationship manager those dreaded few lines. Tell me where to sign. So he pulls out a blank envelope and put crosses over there, and you sign, and there you are. The reason why this happens is very simple. A lot of studies around the world have concluded that we are not hardwired. Over the last 20,000 years of human evolution to understand financial products. There's nothing wrong in this. There's no shame in this. It's a neurobiological thing. It's ingrained in us. We react first. That's how we have survived as a species. That's how we have grown. We run first and then look at the cause later. Otherwise, we would not have survived. We would have gone the way the dinosaurs have gone. We would have gone extinct if we were not smart. Being smart is to react first. But if you react first in case of financial products, you usually end up regretting. Now, apart from this particular reason which is within us, there are lots of other reasons why we make these mistakes despite our best intentions or despite our best efforts. And that is the huge difference that we encounter between consumer durables, or consumer products that we are all the time buying, and then we buy financial products. Our mind is not prepared to buy financial products because we are attuned to buying consumer products and consumer durables in a certain manner. There are certain things that prepares us for that. For instance, you want to buy a mobile phone, you can walk into Vijay Sales, you can ask for the sample, you can test, you can see it's working or not. If you put in your charger, it doesn't charge, obviously there's a problem in the product. It can be tested right there and then. You don't have to wait for 5 years to see if it's grown by 20% compounded or not. Alright? It's not something that you have to wait. Brand names usually stand for something. You buy a product of Apple, you buy a product of Honda or Sony or whatever, those companies have a certain amount of pride. They don't want consumer backlash. They don't want to cheat you. The basic idea of those companies is to improve products, and you can trust those brands. Shop assistants, the person who's guiding you, usually have a very limited role. Here, from the person who is persuading you to buy, from the advertisements right down to the distributor or the bank relationship manager or whoever, or the fund manager who's coming on television, or the media who's writing, there are a hell of a lot of people to persuade you to move the wrong way, in the wrong direction, either deliberately, small number of cases, but a majority of the cases because they don't know and they don't care what happens to you. They have an agenda, or they have a business, or whatever. Usually the difference between one another is very clearly spelled out in terms of price and features. You cannot sell, a consumer products company cannot sell a better phone at a worse phone with worse features at a higher price. It's just not possible. And that kind of correlation is impossible in this case. And finally, when we buy, we go home happy, we expect them to perform. I'll take you through exactly what happens in case of financial products in each of these cases. Financial products are only promises of the future. This is a significant difference. And anything that is not a promise of the future is what people are comfortable with. Anything that's a promise of the future is where all kinds of misbuying and misselling happens. They are to sell you something that either they don't know or they don't care, or you buy something that you haven't checked out, because it's not possible to check out then and there. It's only, you will get to know only in the future. Consumer durables, the stuff that I described, could be a washing machine, or electronics is complex engineering, but we don't need to know any of this. Whereas here is a room full of people not come to listen how a cell phone functions, but what to do with financial products and how to buy, because some technical knowledge is required for this, whether it's a fault of the education system or whether it's a fault of the consumer product or the financial products that have been allowed to enter the marketplace. I don't know, probably a bit of both, but here we are. We need to know. Backed by science and constantly improving. Today's generation of cell phone, to take the same example, is significantly better than what it was 5 years ago, or even 3 years ago, or even 18 months ago. Can we say that the same thing about financial products? Certainly not. Who can say that the mutual funds of today are 20 times better than what they were 20 years ago? Impossible to say that. In fact, virtually the same financial products in some form or the other have been around for the last 400 years. While there have been so-called some amount of financial innovation, as the people in the industry likely to call it, but that kind of innovation is not really beneficial to the average man on the street. To quote Paul Volcker, who was the chief of US Federal Reserve in 1989-90, in that period, according to him, financial innovation and financial engineering is an overstated, overpromised, overused word. There is only one financial innovation that has happened in the last 30 years, and that is ATM. There's nothing else that is of value to us people, or the average people in the street. If after all of these things something goes wrong, really you come, it was working fine in the shop floor, in the shop, but it's not working fine enough over here. What happens? It will be immediately replaced. In this case, there's absolutely no scope for any replacement. You just have to suffer it. Mutual fund companies, insurance companies give you what is called a 14-day free look-up period. That's neither here nor there, because ultimately, as I said, whether an endowment plan or a pension plan is going to give you 3% or 2% or 7%, you will know only in the future. And that depends, as LIC has taught us, on the bonus that they're going to declare later. And that bonus is dependent on what? We don't know. They don't tell us. They have no way of communicating to us. The reason why all of these things happen is because competition works wonderfully in case of durables. You cannot, as I said, get away by selling a useless product at an expensive price. It just does not work that way in the durables business. In case of financial products, there are some 44 mutual fund houses. 44 mutual fund houses, almost 19 insurance companies. And I cannot say with any degree of confidence that one is significantly better than the other and is likely to remain so even in future. So it's not a question of 1 or 2 years, it's years of method and R&D and application that goes in case of durables. Without a regulator, durables business works just fine, but here, despite regulators, there is just no way you can guarantee that a scheme that is not beneficial to you is not going to be sold to you or going to be missold to you. So this is why we make the mistakes that we do. Some of it minor way is our fault, but I would argue almost 80 to 90% of this is not our fault, but we still have to get used to and learn from it. Unfortunately, by the time we learn, it's usually too late, and at other times we are not interested in a story like that of Suchitra Krishnamurthy, who was promised some 24% return by HSBC. Now this is a case, we wrote about it not once but many times. We represented to the RBI, where HSBC is just completely utterly shameless. They do not respond to us, they don't care a damn. So as I said, sometimes it works, sometimes it doesn't work. In this case, it was the exact script that I laid out. She had a divorce settlement from Shekhar Kapoor. The huge amount of money was lying in the bank. The bank came and told her, buy this product, which is an incredible scheme. She wanted to buy a property. So they said that invest here, and out of the returns you can pay the EMI, so borrow. And it's just so amazingly, what a lemon they sold her. It's just so incredible. So all of these things were all in place and mistakes were made. We've done several cover stories which cover many of these, and now in first cover, for instance, you will do a lot of these things, but ultimately you will realize that the value of an insurance is only when you make a claim. Until then, it's only a piece of paper. The insurance is actually tested when you have to make a claim, and claims are rejected on flimsy grounds. If you have not read the fine print that hospitalization has to be communicated in 24 hours to, let's say, United India, that's the rule. 24 hours, if it's a serious case, 24 hours will just go like that, and they'll take advantage of that. Will say, well, you didn't read, this was here, so we can't pay you. We ourselves make a whole lot of mistakes which we wrote about, having written about others, and this is an extraordinary case of forgery and cheating by Reliance Life Insurance of a half-literate guy from Kolhapur. He was a ticket collector. We wrote this cover story. This was a case where actually he got the money back. This was another of those cases where our relentless push actually has worked. And then of course the kind of manipulation that goes on in the stock market. This is just a sample of the things that comprise what I call marketplace. Having figured out that this is the world out there, we need to plan, and that planning is fairly simple. If we keep our requirements very, very clear, and if we just fit in the products that we require and ignore the rest. For this, we need to know about 7 key things. One is that, of course, you have to save regularly, because if you don't save regularly, there's nothing is going to happen out of your consumption. If you blow up the money, then nothing is going to happen in future. You will be short of money, short of ability to finance anything untoward, and so on. Having saved the money, you need to find a way to invest it in products that grows over time, and that grows in a manner to beat inflation. And that's absolutely crucial. I'm holding another session on retirement. That's the second part. The first one I did was to make people aware of how much the impact of inflation is going to affect us over 15, 20, 30 years. We really underestimate this. And while you can look back and say, then why is it that people of a certain generation are not feeling the impact of that, I would only submit that was a different level of inflation and different requirements of lifestyle requirements or financial requirements. 15, 20 years from now, it's going to be a completely different story, and so the impact of inflation is going to be felt much more in future than it has been felt in the past. taxes. This session is not about taxes, but that's one of the things that within the framework of the law, whatever is possible, you must take the maximum advantage of it, whether it's an ATC or any of the insurance premium deduction and so on. Fairly simple, only about 4 or 5 rules. Any chartered accountant will be able to guide you on what at a personal level we can take advantage of. Then comes the three most complex parts of the whole way to plan. One is the expected risk of a particular product. People talk about risk of an asset class. It's a big word, but essentially means that that you should know what is the downside to this. If I buy mutual funds, then what can happen? What can go wrong? Knowing risk is nothing other than knowing what can go wrong. Of course, we are all focused on what can go right, so you need to know that as well, because human mind always looks at the upside and does not want to look at the downside. So the expected returns. This, by the way, is also where people underestimate or wrongly estimate by assuming, for instance, that you can get 25% return from stocks. I'm just giving an example. Not that we make that assumption, but in America, people are making that assumption that they can make 9% compounded or 8% compounded from stocks year after year. In the 90s and in early 2000, this was an assumption, and this was an assumption on which the money was invested systematically by experts as well, and all that has turned out to be fairly incorrect. The way to handle these two, 5 and 6, is find a way to mix the risk and return. So you take a little bit and mix it with a higher return product so that you come out better in aggregate, which is really the idea. And this is, again, people talk about this in financial terms, in jargon terms, but essentially fairly simple, and I'm going to explain that. I'm not going to dwell too much on this. This is fairly obvious. You need to regularly, even a regular savings in FD or recurring deposit schemes. I know of somebody who's doing this fairly regularly for the last 15 years, and he's come out extremely well. He hasn't lost money. The one great advantage of even making a simple recurring deposit investment religiously is that it prevents you from making mistakes of any other kind. So while the returns are going to be not hot, meanwhile you're not being led astray into buying an insurance or a stock or a mutual fund at the wrong time and lose money. If you lose money at that stage 4 to 5 years or 6 years later, then to recover all of that money with as opposed to a guy who is actually investing even on a low return product like a recurring deposit scheme is going to be absolutely impossible. So if you don't understand anything, please understand only one thing, and that is good enough. This covers 60 to 70% of the people and their situations, which is in save as much as possible, put it in a FD or a recurring deposit scheme. That itself is a huge leap forward for a person, because most people do not pay attention. Money is lying in savings account. It is not put into a higher yielding FD or a recurring deposit. If you are able to put that money, as I said, in any form of compounding, long-term compounding, the impact is quite dramatic. Let me give you an example. Suppose this person who is investing only about 1,000 rupees per month or just 12,000 rupees per annum and manages to earn 10% a year. Now, which bank FD gives 10% a year? It doesn't. But if you have a combination, just remember the point number 5, 6 and 7, which is that suppose you put 60-70% of this in FD and 30% or 40% of this in a systematic investment plan, over 15-20 years you're likely to get a blended return of around 10%. That much is fairly guaranteed. Of this, remember that 30-40% part is going to be tax free, because that long-term capital gains in equity mutual funds is tax free. So most certainly post-tax return is going to be around 10% or so. This is how that investment would grow. First year is 12,000 on an average. These are all average figures. Every year nobody is going to give it 1,200 rupees, but on an average it will be 13,200. Next year another 12,000 gets added to that figure, and on that 2,520, which is 10% of 25,200, and the money keeps growing. If this is done, only this is done systematically for 30 years, only 3,60,000 has been invested. 12,000 per year into 30 years. The total wealth is going to be 21,70,000, of which, remember, 18 lakhs has come as income on income, which is that middle part. The principal investment is only 12,000 per annum or 3 lakh 60, and this is how the whole thing will look. This is a 12,000 per month for 30 years, and this is the total wealth. See how the wealth dramatically starts increasing towards the end. This is called the impact of compounding. It's slow in the beginning, but starts increasing very dramatically towards the end. Point number 3 in planning process, the impact of inflation. We don't calculate it. We think, we always think in nominal, as the economists call it, the nominal terms, which is the actual figure, not the post-inflation figure. For instance, if somebody says that I need 12 lakhs for my MBA course, so we never calculate and say 10 years later what would be the value of that 12 lakhs. What will be the cost of that 12 lakhs? Or the reverse way, if somebody says that I get 1 crore rupees 40 years later. 40 years later, what would 1 crore buy for you? So this is a calculation that I have done. 1 crore, if the inflation is 8%, that 1 crore is going to come down to 11 lakhs. The inflation is 10%, then 1 crore is going to buy you whatever 4 lakhs is going to buy you today. This is the relentless impact of inflation. It's exactly the opposite of compounding. Now, if you put a lot of money only in a low return kind of a product, then it amounts to virtually losing your capital. Assume that you put in money in a bank FD which is giving you 8%, and assume that your inflation is 10%. According to me, inflation for us urban people, the kind of products and services that we use, is 10%. It's not 6, 4, 3 or whatever the government cooks up and tells us. As it is, for just about 20 months now, the government of India is publishing what is called CPI Urban, which is Consumer Price Index Urban people. It was never there in this country. That always is, if you notice, just read it in any other business papers. They publish it on the first, I think last Monday it had appeared. So Tuesday's paper would have it, I guess. CPI Urban is 1.5 to 2% more than CPI for the rest of the country. All this while, the Consumer Price Index was meant for industrial workers, because that was a measure of the bargaining. The labor and the government and all of these entities did the bargaining on the CPI. Their basket of products is different from our basket of products, all right? And therefore, our costs for us, which includes services, which includes less of manufactured goods, the cost of manufactured goods is rising less. The cost of services is rising much more. To give you an example, healthcare costs in this city has gone up 20% compounded over the last 5 to 6 years. 20% compounded. If you just make a comparison between what a bypass surgery was costing in Hinduja 5-6 years ago and what it is costing now, you would be able to make a very simple comparison. Now, those kind of services are the costs that are relevant for us, and those costs are growing at, on an average, everything put together is about 10%. So if you put in money in a product which fetches you 8%, and if costs are rising by 10%, every year you're losing 2%. Over a long period of time, that's quite a substantial loss. And let me tell you, there's nothing, it's normal for us not to think of this. I'll just give you a great example of Mr. Keki Dadiset. Okay, one day he was explaining to us that 40 years ago, when he was in, he was in Hindustan Lever, and 40 years ago he said that I had bought a life insurance policy which was supposed to give me 1 lakh rupees. And I look back and I laugh at myself. He's a chartered accountant, by the way, from England and Wales. And I look back and I laugh at myself. What is 1 lakh today? But 40 years ago, he also, like us, thought in nominal terms. 1 lakh, a lot of money. His salary was a fraction of that, all right? So we are, as I said, to repeat, there is no shame. It is part of our neurobiological system. That's the way we have evolved. We are not designed, our human brain is not designed to make these calculations. We have to make a conscious effort to do these calculations and remember and apply. Risk is another thing that we are not usually hardwired to understand. Risk according to us, is a chance of losing money. As simple as that. That's the definition that we believe in, and that's what the definition. Most people intuitively, most savers intuitively would also agree with us. Whereas finance discipline has a different definition of risk. They call this, risk is volatility, which is how much an asset goes up and down. It's of no value to us actually. Ask anybody who has bought a share or a mutual fund at the wrong time and fallen very sharply. He's away totally from the markets. Every month, one headline you're guaranteed to see, which is so many 100 crores have been redeemed from equity mutual funds. This is a story that's been going on for the last 2 years or 3 years almost. No matter which level of index we are, now we are back at almost 21,000 or so. It doesn't matter. People are withdrawing money from equity mutual funds. The reason is very simple. They bought it at the wrong time. Nobody will withdraw money if he's making money. It creates a belief in that product, in that asset class. The only time you will withdraw money when the market is going up is when you see, I bought it at that price, almost near my price that I bought it. I don't want to wait any longer. It's 5 years, I made nothing. Withdraw. Which indirectly proves that they bought it at a peak price. So when you buy at a peak price, you understand the risk very well over the next 3 to 5 years, which is that you don't make any money. But there are other risks as well. For instance, take the example of fixed income, the example that I gave, which is constantly going to be eaten up by inflation. So people have moved from a risk product, buying at the wrong time, to a complete withdrawal and say, I don't want to take any risk, I want safety of my capital, I'm going to keep all my money in the bank. That has got another kind of risk, which is a long-term risk of not able to beat inflation. And inflation is something that you just cannot control. You're guaranteed to have high inflation in this country because of humongous inefficiencies in the system. The system is substantially controlled by the government. The giveaways, the wastage, that is the loot that is going on, is all eventually going to get reflected in higher and higher prices. Real estate risk, like stocks, can fall very sharply. People tend to believe in India real estate prices only go up. They have not lived through the period of 92 to 99 or even right up to 2003. Over 10 years, in many parts of the country, the prime real estate in Diamond Point, for instance, was down by almost 15 to 20%, in some cases about 35% in that period, over a 10-year period. So same story as stocks, because although in this case it's not market linked, but it's a market determined product. People buy and sell at a certain price. You buy at a high price, you have to suffer the consequences of a lower price later. Those who have attended my seminar on gold, I had an extensive one some time ago with a lot of new added information. I have always maintained that gold, investing in gold, not buying for the pleasure of wearing a piece of jewelry, which is a different story altogether. Taking your surplus money out of bank or mutual fund or wherever, doesn't matter where the money is, and investing that money in gold is a purely speculative act. You want to speculate, I mean that's fine, that's your choice, but you need to know when to buy and when to sell. And I will not go into gold in detail in this presentation because it's a much broader one, but I do have 3-4 slides on that for those who want to know. Insurance sounds like absolutely safe thing. You bought it for your safety, right? There are risks there as well. The hidden risk of insurance is cost that you're not told about. So if you bought insurance for investment, the costs are going to eat up a substantial part of your return. And then the hidden cost of your claims not being met, which is the most disastrous thing to happen for anybody who has bought insurance, even if he's not bought it for investment. Cash, of course, is the worst of the lot. Now, I said it's good to know the range of returns that you are likely to get in each of these products over a period of time. Not something like FD, which you all know what you are getting, but any product that is market linked or where returns fluctuate and is only known over a period of time in future, we need to know the boundaries of this, how much and how little, because everybody all around the world will tell you if you do not know these boundaries, you are making a blind bet. If you take the example of Sensex, for instance, it's up 14% post-tax over the past 20 years. Why post-tax? Because for the majority of this period, long-term capital gains either was 10% tax or zero tax. From 2003 onwards, I think it's no tax at all. So that's the kind of return that Sensex has delivered. When you look back, you know that, all right? Bank FDs at the time of high inflation in the mid-90s, the 1-year FD from banks was as high as 12%. This was in 1996. This is a figure obtained from RBI. And minimum, when inflation had really sharply fallen, and if inflation continues to fall as it had started to fall, your bank FD rates also will go down. It went down to as low as 5% in 2004. And mind you, this return is before tax. The point number 4 in plan your finances prudently. This, I mentioned the word tax. It's very, very important not only to save as much money from the taxman on your income, but as well as from your investments. So a pre-tax return of bank FD and post-tax return of a long-term equity mutual fund well chosen is going to be hell and heaven difference. Corporate deposits always pay you much more than a bank FD. The reason is very simple. Only companies that need money borrow money. And companies that need money are not the best of companies. You will never find Hindustan Lever and Nestle out to give you 20%, 12% or even 5%. They're surplus. They're investing money. They want to give the money and earn interest on it. So only those companies which are short of cash, temporarily maybe, they are the ones in the market to raise money. And because it's unsecured, which means if your principal goes, there's nobody you can complain to. They have to pay you a rate which is higher than the bank rate, because bank money is literally secured in this country. RBI has a policy of not allowing any bank to fail. So a company which wants to take away your money from the bank has to offer you a more attractive rate or a higher rate. In 1996, when banks were paying you 12%, corporate FDs went as high as 20%. Of course, not many of that money has come back to people who got 20%, lured by the 20% interest rate, because there's a clear risk return over there. Highest of the rates will come from the worst of the companies. It's as simple as that, because it's a cost to the company. Why would they want to pay you a high rate? You getting a high rate is one part of the story. Why would they want to pay? It's a cost to them. They like to keep the cost as low as possible. The more desperate they are, the higher the interest rate, and therefore the risk to your capital as well. Since 2001, we'd had a new class of investment, and hundreds of crores have gone into this class, which is called unit-linked insurance plans, sold to you very strongly by insurance companies, their agents, and the banks themselves. Part of the money is supposed to have been invested in stocks. So that is why called unit linked. Again, financial services companies find new words to obfuscate, to hide from you the real risks. If they had said stock linked insurance plan, you would not have gone anywhere near any of this. So it's called unit linked insurance plan. What a wonderful way to hide the risk. They have they're like mutual funds, but they are costly. So they take the money, put some of the money in stocks and some money in debt securities, and give you a return based on what they earn minus the costs. We are sorry to say that this is one asset class, even though so much of money has gone into it, there is no database available till today for us to be able to tell you that the unit linked insurance plans overall put together give you an average return of X. We can't say that. And since we can't say that, we've done whatever little calculation we may be able to do. I think in the worst case, you're going to get about 6%. In the best scenario, you're going to get about 8%. And this is post-tax, because bulk of it is considered to be tax-free. If you are not putting money in unit-linked insurance plans, but in one of what is called traditional plans, the older ones, where LIC has fattened itself on those ones, which are called endowment plans or money back or whole life, all of those things, their returns are even worse. It's not for nothing that I chose HDFC Life's name. One product of HDFC Life, we calculated, would give you 2%. A 2% return from one of the traditional plans. All right, it's a remarkable product. Now, all of these things are undergoing some change because a lot of people like us, we have really a small voice, but others are also making a noise. And we are sending memorandum and stuff like that, so IRDA and the banks, they cannot ignore us much. So costs have changed, cost structures have changed, and these products are now being phased out. Whole life policy is being phased out, over a period of time. There's one other asset class which, as I said, everybody would like to know about, and some of them think that it's a good investment bet because it never goes down. Do a math, do the calculation. Last 20 years, gold has fetched only about 9%, and this is a gross return, which is pre-tax return. So if you have, roughly about 15-20% tax to be paid on that based on indexation and long-term capital gains, that's not much compared to a bank FD. Remember that what you're seeing bank FD is today's rate. Rates have gone up and down. On an average, bank FD also would have given you 9.5% on an average in this entire 20-year period. Completely safe. The difference between a 9% of a risk product and a 9% of a safe product is just hell and heaven difference. I don't have to explain this to a saver. Something goes up and down and something remains steady for as long as you want, gives you an interest on your account every quarter, every year, every month, whichever you want it. Hands down, the second one is going to win. Final asset class, as it's called, real estate. Our sense, this is only a summary. I have one more slide on real estate and 3-4 slides on gold to go a little deeper into it. Our sense is that if you that real estate would be slightly better than FD and certainly worse than stocks over the long period of time. There are economic reasons why this should be so, and if you want, I'll explain this in the question answer session. Final point of the planning part, which is that you need to find a way to mix these assets. You can't put all your money in one or the other. If you want higher returns, and you should be wanting returns little higher than the bank FD, you have to take a little bit of higher risk. The opposite, of course, is not true. Taking high risk does not guarantee higher returns, all right? But if you want higher returns, you definitely have to take a little bit of risk. If you want your money to be completely safe, you will have to settle with lower returns. There are many things in finance which is not very clear. This is absolutely clear. This is immutable law of finance, these two things. And you need a little bit of safety, and you need to mix safety with returns. I have a slide later based on what we think, according to different age groups, what the mix should be. People use a mouthful of term called asset allocation. You don't need to know that. Just simple word, mix of assets, where to put your money, not more than in 3 or 4 places. It entirely depends on your profile and when you need the money. What I mean by profile is your age and and how many dependents you have. That is absolutely crucial, because if you're young, you can take much more risk. You can look at a 20-year 14% Sensex kind of a story. If you have dependents, then you would not want to look at that also, not to that extent that a young person who has no dependents would, because you may need the money suddenly because you have dependents. So these are the 2 key things. There could be other factors that you can add in, but essentially there is this whole theory of risk profiling which financial planners do, which is, you don't need to know that, it's all useless. These are the 2 key things that we think, that our research shows, is what determines, in your case, what should be the mix of assets. These are purely indicative. I have made another distinction, male and female. I think by the time I do my next presentation, I'll remove that distinction, because I'm finding the conventional idea that women have to be a little more conservative and so on is not borne out by facts, because the objective conditions of each are exactly the same. This is roughly the mix that you would want to put your money in. I have oversimplified this whole thing, which is equity mutual funds and FD. FD really means fixed income products. It could be a long-term bond fund, it could be bank fixed deposits, it could be corporate bonds. You have to go deeper into that. We are not greatly in favor of bond funds, for instance, because anything that fluctuates up and down. I'll explain the concept behind that fixed income part. You need to keep part of your money which does not move about, where the returns are fairly fixed. You know clearly that if I put 1 lakh in this product, that 1 lakh is not going to become 95,000 under any circumstances. And if I am supposed to get 8,000 rupees out of that, I am going to get 8,000. It will never become 7,500 under any circumstances. Now that figure will change obviously with age, and those who are entering the workforce right now, if they follow that asset mix, my eye is only on 20 and 30. The first one will do exceptionally well over a period of time. One may ask also, why have I put 25% equity mutual fund for those who are 60 to 70 in that age group? The reason is very simple. We do not, most of the research that we do, we try to look at independent of what people, conventional logic is. Most people would have a way of passing that money on to somebody. Either you're donating it or you have legal heirs. 80 to 90% of that would definitely think, what happens to my money when I'm not there? And when you do think of that the life of whatever money you've invested is not limited to your life. The moment you start thinking along those lines, you will see that there is a scope to invest that money, to give that money a chance to grow, not only during your lifetime, but also the lifetime of a person or an organization that you've left it for. There's another way of mixing those assets. All of these examples that I've given are necessarily for a long term. That is because on any kind of investment that you plan to make, which is with a horizon of less than 3 years, your one and only one aim is the protection of capital. If you say, I need this money in the next 36 months, under no circumstances should you put that money on anything that goes up and down. No real estate, no gold, no stocks, no equity mutual funds, because you just do not know what happens to the marketplace at the time, at the end of 36 months when you need it, right? 3 to 5 years money invested in stocks or in equity mutual funds actually start to work. But we've also discovered, at least in 15% of the cases, where even on a 5-year basis, equity mutual funds have barely managed to break even. So there is a chance, a 15% chance that is a chance that you may want to take, depending on your understanding of the marketplace or of the product itself. Only over 5 years that you start making money in higher return assets such as mutual funds. Now, the other thing that when choosing your products that you need to understand is that whether the product beats inflation or not. I've extensively dealt with this. This slide will list down the products that do beat inflation according to us over a long period of time. Real estate does, some ULIPs do, some blue chip stocks does, and equity mutual funds. But you are completely unlikely to beat inflation if you buy insurance. Debt unit-linked insurance plans is a kind of ULIP which invests only in debt, which is a foolish thing to do. You might as well put your money in bank. Fixed income, bank FDs, income funds, gold, none of these things are going to beat inflation. A lot of people have been brought up to believe that gold is a hedge against inflation. Unfortunately, with a 9% return over 20 years, it is not a hedge against inflation. And of course, small savings, which are now going out of fashion. Same products of risk can be categorized for our purposes in 4 different things. I've mentioned this, but it's good to have a refreshed view of that. Super safe, cash, nothing is going to happen to it. Government bonds held till maturity, this is absolutely super safe. This is and class by itself. Safe products, some formal structure of guarantee is in it. Some kind of guarantee. Somebody is guaranteed something. In case of bank FDs, 1 lakh deposit insurance guarantee is there. But there is a real guarantee on your entire savings in bank FD, because our discussions with RBI has repeatedly, they have pointed out that they under no circumstances will they allow a depositor's money to get lost even if the bank is doing very badly. They have done this in case of Global Trust Bank, for instance, where overnight they asked Oriental Bank of Commerce to take it over and depositors' money were completely safe. You cannot say that about cooperative banks though. They do not offer a guarantee for implicit guarantee for cooperative banks. Market linked. These are traded bonds, bond funds, stocks, real estate, equity funds, gold, all of these go up and down. They fluctuate with the market. And the moment you say it's market linked, any product is market linked, it's the risk is not buying it at the right time. The risk is again, second risk is selling it at the wrong time. Then there are whole lot of speculative products, completely you can lose all your money. Ponzi scheme, trading, any kind of futures trading, commodity, forex, stocks. If you try to trade, you are likely to, and there is a huge risk of losing your money. I think for number 3 you should completely avoid. Number 4 you should completely avoid. Number 3 you should be looking at buying only for the long term, provided you understand the product.
You are putting it in number 3.
Yeah, there is value. You are not likely to lose entirely.
There is a mutual fund which was selling the hard bonds.
Yeah.
Which has gone.
That was not regulated.
Now you are saying it is not regulated.
It was not regulated. Now SEBI is woken up after we wrote. They're saying now you are a collective investment scheme. It was an unregulated product. So my first principle, which I mentioned in the beginning, is that never touch anything that is unregulated. And anything that fluctuates, this is not art fund, this is art. So you bought a piece of art for $10 million, it can become 8 million tomorrow. Is it likely to be zero? Well, if it's fake, it's likely to be zero. Gold as an investment. There's a fundamental difference between gold and any other product that we have discussed or that anybody would discuss. It's as simple as this, that there is just no income attached to after you buy gold. There's no dividend, there's no rent, there's no interest, nothing. Nobody pays you anything. You bought it with the objective of either wearing it, if it's a piece of jewelry, or you want to give it to somebody, which is again fine. But if you bought it as an investment, your one and only objective is to find a buyer who will pay you a higher price, a significantly higher price than you bought it for. And that is really the characteristic, the feature of a speculative investment. Now, I won't go into details, but there are 6 factors which determine the price of gold. If you ask anybody at 27,000 with the prices today, if you ask any expert, is the price of gold high or low, then a fair value. Is it, you can always judge a piece of real estate whether it's high or not. It's an opinion, but you can have a view. You can say, 1 crore for this flat is low or it's high. You can have a view, and that view can be fairly established by asking around the real estate broker, the transaction at which the next building has happened, and so on. Can you say that about gold, whether it's high or low in relation to what? You can't do that. You will be able to do only if you are able to analyze 6 factors and put them all together in some kind of a model. And I have not come across that model so far. 1. Gold is determined by the direction of the dollar, because it's a internationally traded commodity. If dollar goes up, price of gold goes down, which is what you're seeing right now. If people feel that the dollar is going to go down for a prolonged period of time, there is an upward push in the price of gold, but it's only one of the factors. Second factor is what is called as I explained earlier, the real impact of inflation. If inflation is 3%, and if banks are paying you 2%, then you're losing 1%, there is an interest in gold, which means you're getting a negative interest. So negative real interest. Then there is a interest in gold. For us, there is a third factor, because we pay for it in rupee. So if you're paying at 40 rupees to the dollar, price of the gold is X. If you're paying at 80 rupees to the dollar, for the same dollar price of gold, you are paying double. It's simply multiplied by 80 in the second case and 40 in the first case. So without doing anything, if rupee keeps going down, your value of your gold will keep going up. You don't have to be a genius. Demand and supply of actual usage of gold in India, but this is overstated. Most people think this is the single biggest factor. It's one of the least important factors is actual user demand of gold. The real drivers of the gold significant drivers of gold are whether central banks, they are the elephant in the room, they come and start buying or selling or not, and over the last 10 years, huge amount of money that is going into what is called gold exchange traded fund for speculation and investment. This is much bigger than actual use of gold. So if you know the movement of all of these 6 factors, the interplay between all of this, and then finally the impact on gold prices, you will be able to have a sense where the gold price is headed, up and down. You can imagine how difficult it is. I don't know of anybody who has a sense of this. People who buy and sell gold are actually trading. All right, it's a speculative trade. It's essentially what I talked about. But I must emphasize once again for the third time that I am not against buying gold, because we need gold in life for various reasons, and you need to pass it on, you need to gift. It's a great thing to wear as well. If you need gold for whatever reason, as I said, the social gold, as I call it, not an investment gold, just buy it. And it's priceless ultimately to you and to the person that you're giving. And most certainly avoid any form of financial gold, which is ETF, e-gold and gold funds. You think you're buying something safe, you think you're buying something you need, and eventually you're buying what is called exchange traded fund, which will act like a stock. Because it's traded in the market, it goes up and down, and there's no need for that at all, because if you want to buy stocks, you will buy stocks. Real estate, big problem in calculating real estate returns is there is just no database of this with anybody, not even the government. The way you can establish scientifically, and this is the reason why people are able to sell products without much research, is that this scientific method and of gathering evidence and doing analysis and finding long-term returns just doesn't exist. National Housing Bank has now started collecting data of real estate transactions over the last 3 years, only 3 years. We do not have a data of last 20 years to prove that if you had bought this piece of real estate or this flat or this land at this place, and over 20 years it would have grown to this rate, on an average, on an annual basis, this is the rate. We don't have that data, so we can't really make a comparison. Also remember, the comparison has to be like and like. Unlike a stock, unlike Reliance Industries shares, which is a share representing the company 20 years ago and also representing the same company 20 years later, a flat in Bandra is different from a flat in Trivandrum. So what you buy, you need data for that particular kind of asset. You can't compare data of Gurgaon with the data of Calcutta. So that creates more and more complexity in arriving at an average rate of return. On the other hand, while returns look very attractive because our mind automatically gravitates to somebody who's bought something and it's gone up 10 times, there are enough of stories which we hear of people cheated by builders, bought and sold at the wrong time. There's somebody I know of bought a Godrej property, very good builder, not cheated by a builder, but for 9 years or 11 years he got zero appreciation. Eventually he sold his flat minus costs and all that, he was at a loss. Alright, so that is the category 2, but at such high prices there is absolutely no appreciation, and meanwhile you have to pay costs of brokerage, registration, stamp duty, maintenance. It eats up a lot of appreciation in real estate. The most amazing thing for us in Moneylife is that this is where bulk of Indian savers' money is going, not into banks, into real estate. We get an email from somebody who says that I have 2 people, we are both working, we're a little worried, what happens if one of us loses a job, they're both in IT companies, we have an EMI of 50,000 rupees. Now this person, if they're worried that they do not have enough of savings and they're giving 50,000 rupees every month to create an asset, it essentially means that almost 60, 70, 80% of the savings are into this one product, one particular product, alright, which is illiquid, which will grow in value undoubtedly, but they will be in a situation for 30, 40 years later of, God forbid, asset rich and cash poor. So all of their investments have gone into something which they need to live in. It's something that they're using. Unfortunately, this situation is happening because although so much of our money goes into real estate, the bulk of it's the single largest place where savings of Indians are going, and there is no regulator. And there is no interest of anybody to create a regulator. And until that happens, that's one more reason for not putting your surplus money into a second home or a third flat and so on and so forth, because you just don't know whom to complain. Malpractices are rampant, returns are not very visible. Real estate, according to us, is only for the professionals who are in the business, who know that is what their job is, and those who have a passion for it. I have a friend of mine, he takes an SUV, he goes out, looks for land, he likes to do that. I don't know how many people would like to do that. And those with lucky breaks, and this is the only thing that you should be looking out for. You have surplus cash, your neighbor is selling your property at a distressed price, you know your flat, you know the locality, you know the price, you're getting it 20% cheaper, he needs the money right away, please go and buy it. That's the only opportunity that I think an average person can do, because all the other things are covered, all right, in this case. Insurance is an investment. A lot of people put in money lured by insurance companies for the children's education, with its pension and so on and so forth. It's good to know what is the business of an insurance company. They essentially offer you a life cover, and then the premium that they get, they invest in other products. Now, if you just think coolly, suppose you have not put your money in ULIPs, nobody is now buying ULIPs anymore. Where would your premium be invested in? Your premium would be invested in another fixed income product. So they take money from you and buy government bonds. That's not a very bright thing to do, right? And then comes all of the costs, the policy administration charge and the fund management charge and so on and so forth. After all the charges, and on the fixed return they make, if your money is going into government bonds, is going to get you gross 8%, not 9, not 10, not 15. 8% is a total income for you through that insurance company. Then comes the cost. If the cost is 1.5%, you're going to make 6.5%. This is the unassailable logic of the traditional insurance plans. There's just no escape from this. It cannot be more than this, because your total income itself is coming from another debt product. Then comes stocks and equity funds, which people are not investing in right now. There's just no interest in the equity market today. There is certainly no interest in equity mutual funds. However, our belief is that this is it's not a healthy thing to do for a young person, especially to avoid equity mutual funds or stocks or whatever completely is suboptimal investment for his savings over the long period of time. The reason why we do advocate investing some amount of money through equity mutual funds is very simple. We think that the fundamental premise of investing in stocks is very sound, which is that you are a part owner of a company which is interested in making profits. That's the fundamental logic. If you have bought 100 shares of HDFC Bank, let's say, a bank which we may not bank with, and the bank which we may not like because they're selling us all kinds of wrong products. But if you're a shareholder of that bank, what happens? You are a part owner of that company. Every year or every day, the top management is meeting. They have a job to do. They're working hard. Some days they're working late, all for one single purpose. Next year's profit has to be higher than this year. This is the only objective of HDFC Bank, and preferably 30% higher than last year, and that has been the record of HDFC Bank. I'm not saying buy HDFC Bank shares, by the way. I'm saying this is the structure of a profitable, well-run organization. They're not fooling around. They're not taking money from you. You bought shares because somebody else sold it. The company has nothing to do with you in that sense. They've not taken your money directly. You're a shareholder, but you get the benefit of high quality teams of people working fairly seriously to create more product, more services, more profits, and you are a beneficiary of that. If it's 30% more, your gain is 30% more next year. Just as simple as that. This is the logic. This is the only logic of buying stocks. Wherever this does not apply, or a company is not interested in increasing profits, they're interested in fooling around with your money or the company, that's a different story altogether. But there are hundreds of such good companies in any country, because this is a structure, they live and die by this. Their own incentives are linked to this. Their next year's salary and increments are linked to this. And you, an outsider, not participating in any of those decisions, you are able to take part of you are able to benefit from that. This is the cold and simple logic. There's nothing more complicated. Let's not make it any more complicated. Now that's why they are the best for creating long-term wealth. This economic logic applies in capitalistic societies. And you can look back and see where the price of Nestle was 10 years ago, where the price of Colgate shares was 10 years ago, and so on and so forth. Now, however, we lose sight of this basic logic and we look at prices. The moment you start looking at prices, you've forgotten that you want to be a part owner of a company and you want a share of the profits year after year. You are sucked into whether to buy at this price, sell at this price, whether it's going up or down. The moment you do that, the volatility starts affecting your mind, all right? But even then, if it does, here are 3 charts to show only on Sensex how even that volatility is substantially reduced over a period of time. Now this is a chart of Sensex yearly movement. Yearly returns is yearly change, all right? It's a calendar year change every year. First few, that was Harshad Mehta, he pushed the market up, so it was high, then it fell, then it stagnated, then one year it shot up again, it was probably 99, Ketan Parekh, then again it went up for 3-4 years, then there was a global financial crisis, it fell again. It almost looks like random. What is the pattern in this? It's not smoothly going up 10% year after year that I talked about earlier, but the moment you take the same data and do what is called a 5-year rolling return. Don't look at 1 year. Say you want to look between 90 to 95 and shift 1 year and you want to look from 91 to 96, 92 to 97. Anytime you are taking a 5-year data, 1 year shifted. This is how it will look. Most 5-year periods, the market is giving you a very positive return. And remember, these are all post-tax returns. If it's 7% post-tax, that is equivalent to 10% pre-tax. All right, only 7%, and it's much more than 7% in most of the 5-year periods. Now, we are again in a 5-year period, unhappily, where nobody has made money, and this is the only reason why people are withdrawing money from equity mutual funds. Remember, this is exactly why this is a period is going to end, and it will lead to either next year or the following year with another good 5-year period. This is the law of stock markets which people have to remember. If I take the same data and do a 10-year rolling return period, let's say 90 to 2000, 91 to 2001, and so on and so forth, there's not been a single 10-year period when anybody would have lost money, would have made more or less, and so on. Now I must warn you that this is only 20-year data. The fact that this has been the history of the Indian markets need not mean that this will also be the future of the Indian markets, but there is a reason why it will be so. Then this is my reason. The reason is very simple. You are investing in, let's say these are 30 best companies, all right? These are the companies which fall into that pattern that I talked about earlier. You get up in the morning, log in at 9 o'clock, you have a job to do, you have a sales target to meet, there are meetings, there are quarterlies, the reports, year-end profit has to be higher. These 30 companies follow that same format. Now, inflation is 9%, let's say, all right? All of these companies have some ability to increase prices, and 9%, mind you, is inflation, and even in a bad year like this, the GDP growth would be 4% or 5% or whatever. The GDP growth figure, 5%, is adjusted for inflation. Sales of companies is not adjusted for inflation. It's a nominal figure. So to put it in simple terms, 9% is inflation, 5% is GDP growth, 14% is the actual growth of the companies, of the country. If the country is growing at 14%, you can very well imagine what the top 30 companies will grow at over a period of time. So as long as inflation is high in this country, good quality companies are going to grow at least at the rate the rest of the country is growing, if not more. So if the sales of that company is growing at 15%, the profit is bound to grow at a certain rate. It will be higher in some year, lower in some year. But this is the reason why Sensex has grown exactly at 14% over the last 20 years. Just simple as that. It merely reflects the growth of the 30 companies, and those 30 companies are taking advantage of a 6%, 7% GDP growth and 9% inflation. This is a logic. Now, how do we take advantage of that? There has to be an investment approach, and I'll quote Nobel laureate Paul Samuelson: investing should be dull, more like watching paint dry or grass grow. If you want excitement, take $800 and go to Las Vegas. This is what Paul Samuelson has said. Now, most people, after hearing all this, despite my preaching long-term, 10 years, 15 years, 20 years, will come and ask, is it a good time to buy? Or there are two questions: which stocks and which funds. Which funds is very easy, all right? We write about it. Annual subscription is just about a few hundred rupees. Value Research has it free. Economic Times has a list. Good mutual funds, fortunately, top 3, 4, 5 mutual funds, fortunately, the ranking is not changing every quarter. The ranking is not changing every year. The ranking is changing maybe once in 5 years, very slowly. It's very easy to identify a good mutual funds. I'm not mentioning them over here because I don't want to be seen as advocating this fund or that fund, but they're freely, easily available anywhere. That when to buy and which stocks to buy is less important than how you want to buy this, and that takes to almost my last part of my presentation. You must at any cost avoid investing lump sum unless there is some mechanism which many of you are very focused on stocks. You've sort of looked at companies, invested, gone in and gone out. I have actually come across retail investors in this country who are smarter than large institutional investors and so-called experts, and the reason is very simple. They're investing their own money, and the Americans have a term for this. They have a skin in the game, which means they are in the game and the skin gets hurt if they don't play properly. So they're investing their own money, and they do it very well. If you're one of those, you would very well know lump sum investment is not the right way to invest. But if you have by any means some sense of timing, there are people who are endowed with it. There are people I know who are absolutely calm and cool when the market is crashing, and they just go and buy. It's probably a gift. They're not supposed to be like that. As I said, the evolutionary biology of ours has not prepared to be like that. We are supposed to run away from problems. That's how we've survived as species. But there are some people who've trained themselves. They go walk across and buy when everybody else is selling. If you're one of those rare people, then do buy lump sum when the market is crashing. But by and large, invest regularly, fixed amount of money or a variable amount of money. I'll show you a chart by which you'll understand what I mean. Suppose take 2 different periods, last 5 years, not today's Sensex, maybe this is maybe 2 weeks or 3 weeks ago. Over 5 years, Sensex is virtually the same. It's actually down 1.68%. From 19,800, it's down to 19,500. If you had put all your money, let's say you could put all your money in Sensex and there are no costs, etc., you would be down 1.68% over 5 years. But if you are invested systematically every month, your portfolio would actually be up 22%. So you would be able to take advantage of the time the market went down and take advantage of the time when the market went up. For all stagnant markets and for all declining markets, there are three possibilities that you face. A market that is falling, a market that is relentlessly rising, that we saw from 2003 to 2008, which happens once or twice in a generation, and by and large market that fluctuates and probably mildly trending upwards. For the first and the third case, this is all going to work out wonderfully. Only in the second instance, which nobody can predict and happens once in a lifetime, when market is up 40% compounded over 5 years or so, that this is not going to work and you might as well put all your money lump sum. But we do not know when that period is going to come. We cannot anticipate, and it's not worth it. For all other periods, this is what is going to work out beautifully. I'll summarize the successful process. Please think of at least 5 years plus. There's a 15% chance that over 5-year period you might have to suffer a little bit of loss. Even then, well chosen funds have done very well over the last 5 years also, if the Sensex hasn't. Short term compels us to make mistakes, long term helps us reduce volatility, which I've explained. Invest regularly and invest only what you can spare, because this is linked to the first. If you do not invest what you can spare, you will always be worried that why have I put money in this. If it is the money that you can spare, you are a little calmer, you can give it more time for it to go up. Invest in the right proportion, which I've also explained, what others call asset allocation. 40-60, 70-30, choose whatever suits you fine, but choose a proportion of that. And among the long list of things that you would like to avoid are these: portfolio management schemes of brokers and mutual fund companies. Hot stocks and tips, somebody said this is likely to go up, just ignore it. He doesn't know. Most people do not know. This is all spread very deliberately. Art funds, you certainly should avoid. Commodity trading, you certainly should avoid. Forex trading, you're likely to lose money in all of these things. Private equity funds being sold through banks. One of the worst things are private equity funds. No exit, returns can vary, and most of them themselves are crying because they have invested 4, 5, 6, 7 years ago, and there has been no initial public offering market for them to exit into the companies they have invested. Real estate trusts, the same story. These are meant only for finance professionals. When I say professionals, it's meant for finance professionals. They can judge, they can decide what they want to do. They probably know the risks. They're probably greedy. Let them do whatever they want to. If you are ever tempted to invest in any of these things, please write down a figure, share it with your wife, and say, I'm investing 1 lakh rupees or 5 lakhs, 10 lakhs, doesn't matter in this, and I'm willing to lose this money. Tell yourself, tell others if it's possible, and go ahead and do what you want to. To sum up, define time goals and time periods, choose the few right financial products that you need, invest money for the long term, invest regularly in fixed proportion of your savings, and you will be absolutely fine over the long period of time.